This Week in Startups is brought to you by Braintree. Looking to set up payments for your business? Braintree gives your app or website a payment solution that accepts just about every payment method in one simple integration. Plus, we'll give you your first $50,000 in transactions fee-free. To learn more, visit braintreepayments.com/twist. And Citrix Go-To Meeting. Meeting is believing. Visit gotomeeting.com, click the Try It Free button, and sign up for a 30-day free trial.
Today on This Week in Startups, Jason Lemkin, the #1 investor in the SaaS space. Yes, software as a service. Software is eating the world. People paying for it with a monthly subscription is a huge, huge paradigm shift in all of software and computing and business. And Jason Lemkin has separated himself from the pack of VCs as a 20-year entrepreneur, as the expert. And he talks in a rambling, just data-filled 90-minute conversation that is reminiscent of the famous Chris Sacca episode where we talk about everything for 90 minutes in the SaaS world. It's a great, great episode, destined to be one of the best of 2015 and perhaps one of the best in history. Stick with us. It's an amazing episode of This Week in Startups.
That's what it's all about, man. They said, money is the root of all evil. What? Funny how it feeds my people. Yeah. We ain't gonna live like equals until we get the money, spend the money, and defeat you. Yeah. Money is the root of all evil. What? Funny how it feeds my people. Yeah. We ain't gonna live like equals until we get the money, spend the money, and defeat you.
Hey everybody, welcome to another episode of This Week in Startups. I'm your host, Jason Calacanis, and this is the podcast where we talk about changing the world and solving incredibly large problems, or just making life more delightful for all the residents of planet Earth. And how do we do that? Through startups. We build stuff, we build companies. That's why we call the program This Week in Startups. Now, we do a couple of different formats on the show if it's your first time listening. Sometimes we do a news roundtable. Typically we do that on Fridays. And then I like to do interviews. And who do I like to interview? Well, there's really two people in this ecosystem that matter. One is the founders. Without them, there is nothing. But there's another critical role, which is the people who give the founders the money to pursue what they do. These can be angel investors like myself, venture capitalists, private equity firms, AngelList syndicates, a lot of different funding sources these days. And we like to talk to the investors because the investors really are in an incredible position in life and in the universe. There's a small number of them, and they spend their time listening to where entrepreneurs think the world should go. They basically get pitched on what's the future of the world. And then they have to decide who to give $25, $50, $500, $5 million, $50 million to. This is heady stuff, isn't it? And today on the program, I have Jason Lemkin, who is, I guess you're kind of like, a SaaS is kind of a new thing, but you're kind of like the SaaS godfather.
I like, or I prefer uncle, but Godfather's all good. They're all good, yes. Yeah.
You're famous for investing in SaaS companies. Explain to the audience who doesn't know, what's a SaaS business?
Yes. So I've been an institutional investor, VC, for the last 24 months. Before that, I was a founder myself. So 2 startups. The last one, a company called EchoSign that Adobe acquired. And, you know, what is SaaS? Software as a service. So it's web services, broadly speaking, that people pay money for every single month. They're not free. They're not one-offs. And the definition can be fairly broad. For me, the common denominator is one or another we're selling it. Right? Whether we're selling it through just freemium, which I'm actually a little bit less interested, but still interested, or whether selling it through a inside sales force, a field sales force, whatever. The common denominator for me is you pay every month, and one way or the other, you sell and market it. The money just doesn't magically come in.
And this was a big paradigm shift in software, because when I came into the industry, I remember in the 80s, everything was packaged in a box. And when we used to install Lotus Notes or a document management system or Microsoft
you're dating
Office,
yourself, you know.
I know. And I was like 18, 19 years old. We would set up a Novell network. We'd set up 50 PCs or 100 PCs in a law office. And then we would literally get huge crates, a pallet of Microsoft Office.
Yeah.
And we'd have to unbox each one, put the instructions on the shelf, take the CD, and install it one at a time. It took hours to put Microsoft Office on everybody's computer.
Yes.
Why did the industry shift from packaged software into software as a service and people paying, by the month?
Yeah, I think.
And when did that happen?
I think it's confusing because sort of two things happened. There was a business model change, which we can talk about second. Like take Adobe, where I was a VP for a while. Adobe launched its Creative Cloud and then Document Cloud, which EchoSign is the center of. In some cases, that's taking packaged software, right? Like Creative Suite.
Photoshop was the perfect example.
And Photoshop, in fact, as part of Creative Suite, it's still something you download to your computer and install, just like before it was a cloud product. So in some cases, and there are products like Behance and others that are part of that are web services, which I'll get to second. But some of it is literally just a new way to pay for something we've done before and download. That's a piece. So a business model. I'm going to pay every month. I'm going to pay $30 a month for my Creative Cloud instead of $1,500 or $2,000 for Creative Suite. And for Adobe, if you look what happened to their stock price the last 2.5 years, it was magic, right?
Why was it magic? What happened?
Because Wall Street loves recurring revenue models, right? Which we could be skeptical of because it doesn't necessarily mean you have any more revenue, but Wall Street loves recurring revenue. It's predictable. It's predictable.
Got it.
Right? We don't like Oracle. We don't like SAP, where you sign a large deal and then it's all maintenance and other services later, right? We like this Salesforce model where realistically, not only are you locked in, but you're locked in with Office and Oracle too. You're locked in paying every year. So Wall Street likes the financial engineering side, but that's not really what's really changed everything and what's interesting. That's the business model side that lets VCs and angels invest in this. What we didn't really get even back in 05 and 06 when this next generation came out, it's about collaboration, right? And collaboration's an overused word. But really all these products that have blown up are ways for us to use business software and work together with our customers, work together internally, work whatever. And it's a trite term, but when Web 2.0 came out 10 years ago, we were all kind of consumer-y collaborating, whatever we knew. But B2B enterprise is like 3 to 5 years behind. And so it's really collaboration that's driving all of this. And that enables SaaS products not just to mimic what happened before, but to do brand new things.
Got it. And so who would you say was responsible for this revolution in the pricing of software and the distribution of it? Who were the early proponents of it in the space? When did they first start to appear, this monthly subscription for software? When did you first
Well, let's be clear. We all owe a huge debt to Salesforce. Salesforce.
They were the first one.
Salesforce, marketing pushed through the whole idea of no software in SaaS, pushed through the idea that people would pay $19 and then $80 and then $200 or $300 a month per user for a product.
Is that what people are paying for Salesforce now? $200 or $300 a month?
Or more. Salesforce is doing 9-figure deals now. Nine-figure deals. Well, Salesforce is at $6 billion in recurring revenue. $6 billion. How do you get to $6 billion? You don't get there with $5 a month.
Right. And
even Dropbox ain't going to get to $6 billion in revenue with just a $5 a month addition.
So ultimately, this was about getting people in at a lower price.
Yeah.
And that played a big part in it, didn't it? That you could actually sample the software. And that was the big fear, I think, of people was, oh my God, we need to convince them to get $400 per year per seat.
Yeah.
Not $30 a month or $35 a month, because they're going to use it for 3 months and then they're going to realize they don't get value and then they're going to leave.
Sort of. I'd say sort of. There's a lot of things that are a little bit apocryphal about B2B, about SaaS.
Producer Jackie, can you look up apocryphal for me?
An interesting one that I learned as a founder, I didn't know this either, because at EchoSign, we started as a freemium product and became more enterprise.
Got it.
I didn't realize that the bigger the customer gets, the less interested they are in trying the product at all. And in fact, as the deals get bigger, as you go from 4-figure to 5-figure to 6-figure deals, a minority of your prospects and leads will even try the product, even though this is the internet. Like, guys like you and me and everyone listening to this, what do we want to do? Do we want to talk to a sales rep? No, it's the last thing I want to do with my time, right?
Oh, I want to talk to a sales rep as much as I want to talk to the taxi dispatcher.
Yeah. And it turns out...
Which is to say, never again in my life.
Yeah, folks like you and me and 95% of the people listening to this, we're about like 15% of the B2B or SaaS buying world. 15% of the world... There's guys like us. We either built software, we understand software, we live on the internet.
Yeah, here's my credit card, let's go.
Yeah, and we're sort of a weird combo of intro and extroverts, and we want to be left alone up until a point we need help, and we'd rather not talk to a person to get help, and then we only want to talk to someone to give us help, and then we want to talk to a sales rep.
And we want to talk to them in a chat room or email.
We don't want to talk to them.
if we talk to them.
Turns out if you're a mid-level manager buying a web product at Qualcomm or even Google or wherever, sales isn't a pain. Sales are the guys that do the demo for you. They set up the demo organization. They do the work for you.
Right.
So my Uber point, we could talk about this forever.
Yeah.
The idea that what drove SaaS was try before you buy is a bit apocryphal. It's definitely true at the low end. It's true with the Evernotes and the Dropboxes, but it's not even true with Box anymore. You know, for Box, less than 1% of their revenue today is freemium.
Interesting.
Less than 1%, right? Really important for marketing and brand. And I'll bet you if you ask Aaron Levy of his 7-figure deals and above, how many of those folks try before they buy for real?
Yeah.
It's small.
All right. When we get back from this commercial break, I want you to tell me and give a grade
Yes.
to the biggest software company in the world, I believe, Microsoft, and how they've done in adapting to a SaaS world when we get back on This Week in Startups. Hey, everybody, let me tell you a little bit about Braintree. It's a full stack payment solution for all your payment types for your customers. Yes, you can do mobile payments fast, easy, seamless, and secure. And you can add it to your apps with just a few lines of code, and then you'll be able to accept Apple Pay, Android Pay, PayPal, Venmo, credit cards, and of course, Bitcoin, everything. And if some other new way to pay people comes along, you know the Braintree team will support that too. Developers love it, founders love it, because it's got superior fraud protection, fast payouts, and continuous world-class support. You'll have fewer abandoned carts, more sales with Braintree's best-in-class mobile checkout. And their customers include, are you ready for this? Uber, Thumbtack, Hotel Tonight, Airbnb, GitHub, and StubHub. And I'm an investor in 2 of those 6 companies. And you'd be in good company to be in that class of companies. Well, here's a call to action, everybody. They're going to give you $50,000 in transactions fee-free. Yes, that's for the people who are on the This Week in Startups audience. If they go to braintreepayments.com/twist. braintreepayments.com/twist, and you'll get $50,000 fee-free. You can't go wrong with that. Developers love it. It's easy to use. What more do you need to know? Thank you to my friends at Braintree for sponsoring independent media like This Week in Startups. Okay, let's get back to the program. Hey, everybody, welcome back to This Week in Startups. I'm your host, Jason Calacanis. You can follow me on Twitter at Jason. My guest is Jason Lemkin. And people are mistaking us on Twitter. They're like, oh, just ask Jason.
Yes.
And then I'm like, oh, I'm here. And they're like, what, you idiot? We want the Jason Lemkin who
I've got the LK.
About.
You've got at Jason. That's far
better. And then you can follow Jason LK, not Jason LK, which stands for Jason Lemkin, who, if you go to saastr.com, is his website. Saastr. Saastr, is that how you pronounce it?
Saastr.
And at Saastr, he is the godfather of SaaS, pretty much the most notable investor, or one of the most notable investors in the SaaS space. Obviously, he's been an entrepreneur for a long time, and now he jumped on to the evil side. He went to the dark side with me. I'm still an entrepreneur, so I'm only half on the dark side.
Yes.
I'm like Anakin, like with that, like when his arm was cut off, somewhere like
you're like during the Clone Wars.
I'm during the Clone Wars.
Well,
you know, I'm kind of like split.
You can see hints of it, but I
have some good in me. There is some good in me. We can't find it that often.
Yeah. Let's come back to that topic before we run out of time.
Exactly.
Yeah.
Hey, so when we left for the break,
yes,
I wanted to ask you about this little company called Microsoft.
Yes.
Which I had forgotten about, but I spent 20 years with. And then all of a sudden, I get my iPad and I'm like, mailbox is crashing. Google's, email client sucks.
Yeah.
The mail client from Apple is just insanely bad.
Yes.
And I download Outlook because somebody says Outlook's amazing.
Yeah.
Now I spend...
You love it.
70% of my time in Outlook because the calendar, the notes, everything.
And how much do you pay for it?
$0. But I'm actually thinking of getting this $20 a month for Outlook and the Microsoft suite.
Yeah, Office 365.
Office 360.
Yeah.
So Microsoft has been hit hard by the SaaS revolution.
Yes.
Explain to me what they've done right, what they've done wrong, and how that transition has impacted them, their stock price, their corporate culture, et cetera.
My view, I think the Microsofts, the Intuits, even the Adobes, where I worked for a while, to some extent they're biding their time, And what they've done an amazing job of, as we alluded to earlier, is financial engineering. So Wall Street likes recurring revenue. So, but you used Outlook that you use on your iPad, right? It's a great app. But Office 365, which I use for PowerPoint, you know what it is? It's software. You go to Microsoft's website, you download it. It can take 5 to 6 hours to download sometime if you're not in the right CDN.
Wow.
And then you have to put in your credit card and do everything. And so it's downloaded software that instead of pirating or paying $99 a month for Home and Student Edition and pretending you're a company, you're paying $99 a year.
Because let's face it, what people were doing all over the startup world when I came into the business 20 years ago is they would buy one copy, or they would take their student copy, and then literally go to every computer on the network, install Microsoft Office, and then Adobe and Quark Express, which we used to use at the magazine, I found out subsequently later, and I corrected it, that a couple of rogue designers were using Quark Express and some of these other things. And then what they found out when you got on a network, they would shut each other off. So then what people would do is they would unplug their network cable, use the product, and when they had to check their email, plug the cable back in, which was hilarious to me. But they moved from packaged software now to monthly.
Yeah, and that helps. But really, let's boil it down to something simple. Let's forget about piracy, which I learned at Adobe is not a big deal, it turns out.
They like piracy. Piracy means...
It's not impactful. It's not material.
But it's the people who pirate are people who are not generating revenue from the product yet.
It's marketing at the end of the day, right?
It's the training wheels.
But let's say we were pretending we were businesses and we bought Office Home and Student Edition for $99, which we could use for 10 years, right? If instead I pay $99 a month for Office 365, I mean, Microsoft comes out so far ahead. So these companies that are moving to subscription models and that are pseudo SaaS are going to have 3 to 4 to 5 great years ahead of them, right? And you can see it particularly in Adobe stock, which in this rise that we've been in has gone from something like 20-something to 80-something.
Full disclosure, you have some.
I have none. I have no
Adobe
stock.
Sold it all.
Yeah, I'm all out 2 years ago.
No conflict, everybody.
No. And I'm a fan. I think Adobe did some of the best financial engineering in this space in the history of mankind. And Microsoft and Intuit are trying to copy them. But at the end of the day, what have they changed the paradigm and have they caught up? And Microsoft's done some interesting things. They bought Acompli and Wunderlist and a few other things to kind of take these products we've used for decades into the new world. But it's hard for me to believe that that's going to have a material impact on revenue. The problem is these guys are just hamstrung by the materiality threshold.
What does it mean, materiality threshold?
If you're
materiality threshold.
I mean, Adobe is doing Adobe and Intuit do $4 billion a year in revenue. We'd have to look up Microsoft. I don't know. I'm assuming it does 40 or 50 billion a year. Right?
Oh yeah.
So just to move the needle, you need to do 10% of that. So is this free Office app you're using going to do $4 billion of new incremental revenue for Microsoft? No. Right? And they've also lost much of mobile, right?
Yeah.
So I think the big guys for SaaS, they're doing what they have to do to stay in the game, to keep their products current. But they haven't innovated in any interesting way. Or like Oracle or SAP, they're buying all the old stuff because it has scale. They're buying these old things like Concur, SuccessFactors, or Taleo, names you might not have heard of, but they're all doing tons of, they spent billions buying, or even older stuff like Responsys. I mean, this dated software to try and get scale. But if you're buying 10-year-old technology, at the end of the day, you're not buying the future, you're buying the past, right?
Right. So they can goose their revenue number in the short term.
Yeah.
But there's going to be a SaaS product that's lighter and cheaper and faster and better.
Or just more innovative, just more collaborative.
More collaborative,
right? The Slack of you're going to turn around, the Slack of your space is going to come out of nowhere.
Why is that company so special,
use
Slack? I I know Stuart and we're friendly, and I know Chamath and all the people who invested in it. But what do you think it is that has made it grow so hockey stick like a consumer product while charging like a SaaS product?
Yeah.
It's the first company to do that, isn't it? Grow like a consumer product.
Well, we could argue. I'll tell you my views of Slack, and I think Slack's super interesting. I'm not sure Slack is actually so different than Atlassian. And Atlassian is
which is HipChat, which is what we use.
HipChat's a piece of it. Atlassian is going public now with hundreds of millions in recurring revenue and hundreds of millions in services and perpetual license revenue.
Right, with no sales team.
No, and it's going to be an epic, whatever the valuation is. And the founders own, I believe, 70% of that company.
It's an Australian company.
One round of venture capital.
I know, it's an Australian company. And their whole idea was no sales team.
Yes.
And I think when they got a little bit more competition, they added like a little sales experiment.
There's always a little bit there. There's an assist. There's always when they say there's no sales, there's always an assist. Right?
Okay.
And so
what's unique about Slack and HipChat? Those two.
I think what's
I'm in HipChat
confusing
right now, talking to
about
producer
no one was confused what Atlassian does. Atlassian primarily has sold tools either to developers or to folks building software or to folks in their organizations that are tied into this, right? Slack, I think we have to give Stuart and the team like a 12 on the PR scale, right? Possibly a 13. I mean, as good as it gets. But there was a lot of PR about Slack being, quote, enterprise. It's not.
Why is it not?
Slack grew up as a product that people who build software like you and me use to build software. And what's bitching about Slack, beyond the cool UI and that it's fast and that it works on every device, is that it integrates with everything in the world, right?
That's the
every
cool
single
part.
product you use, every single bug tracking tool, CI, CD tool,
If you want to
anything.
take your Zendesk, you put it in there.
Everything. So it's a beautiful way for folks to passively or actively observe how software is being built in their organization and talk around it. And so I'm not saying that in a year or two, maybe Slack is all used by mid-level managers in HR in big companies, but it's a bit apocryphal as well. It is another cool software product development tool, but took advantage of where collaboration is today and where APIs and integrations are today, and made it just so much more valuable. And then everybody was willing to put a little bit of their budget to build software better.
Yeah. It's very interesting. When you get those integrations, you get the lock-in.
Yes.
I'm a big fan of this Zapier.
Yes.
You know this company,
Yes.
Zapier?
Yeah.
Because everything I use, we use Typeform, we use Slack, we use HipChat,
Yes.
Google Docs, and now you get Zapier in between them. You get to, I'm like, I sit there sometimes and I'm like, what could I do that would make my team more bionic? I know.
Yeah.
Every time somebody puts a request into a Typeform to be a speaker, let's put that into our HipChat room.
Yes.
Let's send an email. Let's append a Google spreadsheet. I love this Zapier.
It is cool. Although one thing my learning, and I'll challenge something you said, but I didn't know this myself, is there's no such thing as lock-in. Lock-in's a myth.
All right.
Lock-in is a VC, internet blog, Twitter-driven myth.
Hold on a second, though.
Yes.
I took all the time to set up all these Zapiers.
You did.
I would loathe having to go do all that work again once I get 15 or 20 of them.
Yes.
Why on earth would I then go get, I mean, it's one of the reasons I'm still on HipChat, not Slack.
Yes, but you're right.
Like, I don't want to go do all that work again.
And if the world doesn't change, and
isn't that the definition of lock-in?
If the world doesn't change and your vendor keeps up, you have sort of an either implicit or explicit lock-in.
Yeah.
But the world changes. And, and if you're not on top of your game, now you may not change from HipChat today, but you know what? In 2018, when you have rebuilt your whole network on top of 40 other apps, and Atlassian got distracted, and they didn't do those integrations, and Slack has them all, you might change. And so what I learned in the enterprise is churn usually happens around year 3, it turns out, because you buy the product, right? And the first year, you just figure out how the heck it works, right? And then there's either an annual renewal if it's more enterprise, or there's a mental renewal for the next year. And you're like, well, HipChat's great. It's okay. I'm going to keep it for the next year. And then you start seeing the cracks the year afterwards, or you start seeing that everyone's using Slack, and you start seeing
the 3-year itch.
The 3-year, and then finally,
not 7.
Finally, it comes around during the 3rd year. You're like, you know what? Maybe this year we're gonna have to rip out everything, and we're gonna have to do new Zaps. We're gonna have to do everything. But everyone on my team wants. I'm happy with HipChat. It works. It works on Twist. It works everywhere. But I want. Everyone wants Slack, and so don't get comfortable with your so-called lock-in or lack of churn because it's year 3.
Interesting you mentioned this because we're HipChat users at launch. At my other company inside, the developers started using Slack even though we had HipChat.
Yeah.
And I was like, hey, Ixnay on the Slacksnay, why do we have 2 systems?
Yeah.
And they made me a huge list.
Yeah.
And I'm like, you know what? I give up. You guys do what you want to do. If I'm outvoted and the team wants to use Slack so badly at Inside, go ahead.
Yeah. And you know what might happen in 2017? You might all use Slack.
Well, here's the thing.
Yeah.
One of the things I like now is I have Slack over here and HipChat over here. One team.
Yeah.
It keeps me fresh on both products.
Yeah.
Just like I have a Samsung Android phone. I have the Edge.
Yeah.
With the Edge curved. I love having my Samsung Edge because that keeps me up to date on Androids. And it's like, my God, this phone's got better hardware than the Apple product.
Yes.
I like that.
But here's the thing, and I'm a huge Atlassian fan, right? You have to be a fanboy as a founder, right? They've done it all the right way.
Yeah, they kick ass.
But here's the thing.
I also like Slack.
Slack is putting so many resources into building this product that in 2 years, HipChat...
Game over?
They can't keep up. unless the paradigm doesn't change. Sometimes you do have a static paradigm. Let's not be so. Lots of parts of Eventbrite, as near as I can tell, haven't been touched in like 7 years if you look at the UI.
Yep.
But it just works,
Network
right? A lot of issues with Eventbrite, but I'm never going to switch. We tried to use other software, just forget it. So sometimes paradigms, especially when it gets really enterprise.
You know what I did with my my Eventbrite?
Yeah, what'd you do?
I moved it to Typeform because Typeform supports
Eventbrite, including the back end or just the front end?
Here's the thing. Typeform, you fill out a form.
Yeah.
And then they include Stripe. And it means I can do whatever I want in the form. And so
how do you do
then
refunds? How do you do refunds? How do you do?
Yeah, that's
how do you print out badges for 5,000 people?
Very simple.
How do you do check-ins?
Yeah, that's something we all have our own system for because we have 15. Here's the thing: when you become a 15,000 person conference like Launch Festival is, those things you're going to do a solution for, and Eventbrite solutions actually don't work.
Okay, but you built your own software.
Well, we customized it with Eventbrite because it's so customizable, and then these platforms never do it. So I think like for the mid-tier and you don't want customization, Eventbrite's fine. But once you want to do these customizations, Eventbrite's like, we don't do that.
No, they don't want that.
And we don't want you as a customer anymore, right? Because it's like, well, we want to do special stuff. All right, listen. When we get back, I have two very important questions that I want Jason Lemkin to answer. You're a pretty smart dude, by the way. And I know a lot of smart people, so it's a pretty big statement. If I say you're smart, I think it's actually very good. It's a very astute observation. You know what? So many people are like trying to be experts on so many things. They're jack of all and master of none. But I want you to answer two very specific questions.
Yes.
The first is, what do you look for in your angel investing?
Yeah.
And then number two, if Microsoft and Google, like I've heard buzz of, release a free Slack competitor.
Yes.
What happens to Slack when we get back on This Week in Startups? Hey, everybody, let me take a moment to thank our friends at Citrix GoToMeeting. I mean, gosh, think about all the time and money and hassle it takes to hold these meetings. My God, you're going down to the valley, up to San Francisco, the traffic, the cost, the flying places. And my recommendation is that you meet your clients and coworkers over Citrix's GoToMeeting. It is a smarter way to meet, and it has beautiful HD faces, amazing HD quality. I just did an all hands with my team from inside.com, and it was perfect. Everybody had crystal clear VoIP, or they were dialing in. And people were on different platforms. Some people were on their smartphones. Some people were on tablets. Some people were on desktop computers. And you know what? I have a real thing. I want everybody to have like a headset on. And some people forgot their headsets. And it still sounded really good. It's really the most professional meeting product on the market. It's very affordable. I've had it for many, many years. I think I'm close to a decade using GoToMeeting. And I want you to try it and sign up for GoToMeeting today. You'll get it free for 30 days. You have nothing to lose. So visit GoToMeeting.com. Click the Try It Free button. And if you do it now, your first meeting will be up and running in just minutes. And that's GoToMeeting, and your first 30 days are free. It's a fantastic product. You can also, it has a chat room in it, which is also a nice feature. I like to have somebody take notes and put it in the chat room. You can also record the audio from it in case you want to share that with everybody. And you know what? I do that as well. It's a fantastic product. Thank you, GoToMeeting. Let's get back to this amazing episode. Hey, everybody. Welcome back to This Week in Startups. My guest, the brilliant Jason Lemkin, who is the godfather of SaaS. What is SaaS? Software as a service. Paying monthly for your software, enterprise stuff. He angel invests in it. He makes a ton of money doing it. And you can find his work at Saastr.com. SAASTR.com. What do people find at Saastr?
What do they find?
Yeah, what do they find there? When I type in the domain, what am I going to find?
You will find help learning how, once you have 10 or more customers, how to scale that to 10,000.
Okay. So to take 10 to 10,000.
Yeah, but if you're not at 10 and they're not, and there aren't 10 folks that aren't your uncles or ex-friends or ex-colleagues, then you won't get anything out of it.
Ah, got it. Hey guys, when I play with my screen like that, that means I want you to pull it up. When you see my screen bouncing around like that, that means pull up.
That's the special
Jason.
nonverbal cue.
Yeah, the nonverbal clue is when I do this. See, look, see, watch here. I go bonk, 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 bonk.
There we go.
There it is.
Looking good.
Saastr. Everybody go check out Saastr. Now,
check it out.
Also, what's this about?
Yeah.
A conference.
A conference.
Saastr Annual 2016, from impossible to inevitable.
Yes.
San Francisco, February 9th to 11th. Look at this. You're copying my website design, too, with the video in the background. Very good.
Not intentionally, but maybe.
That's all right.
Yeah.
Maybe you're using, maybe you're just using Squarespace.
It's a custom WordPress theme.
Custom WordPress.
That was a headache.
It's a little bit of a headache.
What
What will people learn at the SaaS Annual 2016 event happening in San Francisco from February 9th to 11th?
They will learn how some of the best of us have scaled from $1 million in revenue to 5 million or 10 million or 100 or 200 million. So it's not a place to go if you have no customers or if it's too early, but it's the place to go once you can see at least $1 million in revenue out there on the horizon and get together with a few thousand other founders at the same stage.
What does this cost? $8,000 a ticket?
I think a founder ticket's like high triple digits. For 3 days, food,
$600, $700?
Something like that.
So you don't make any money off this. You just break even.
No, we break. Yeah, we could talk about. You know a lot more about conference economics than I do. But
I break even too, and then I make it back on the angel investing.
Yeah, it's a lot of work.
We're effing with the system.
Yeah,
we're screwing up the whole conference business because if you're an angel investor like you and I are, that's top of the food chain.
Yeah,
right. People want to hang out with the people who write checks, and then if you do a conference and you don't have to make money off of it, then all the jerks who are charging startups $5,000 for a table, $10,000 to get on stage, the demo conference disrupt all these people who are Web Summit trying to like screw founders.
Yeah.
I said it, not you. I know you're trying to be.
Well, I learned those are 60% margin businesses when you do it that way.
Yes.
There's three types of conferences. You know better than me. There's 60%, there's 0%, and then there's like negative 30.
Yes,
right?
when Box or Facebook do their events, they're loss leaders to build the platforms, and those guys are printing money.
Yeah.
When Disrupt and Web Summit and those guys do it, they're just price gouging everybody $10,000, $20,000 demo to get on stage.
Yeah.
Desperate founders. It's really loathsome. It really is. It makes me sick.
Yeah.
People make me sick. Like they're just like these desperate.
But just putting on the event, just putting on the event itself is expensive.
Millions of dollars.
Right.
In your case, maybe $500,000. I don't know.
No, it's $2 million just to turn on the lights.
Maron, you're doing it at a hotel.
To rent the Masonic Center in San Francisco for a week.
Eesh.
And to have bars that open at noon.
Eesh.
Bars that open at noon, that's $2 million.
Crazy. No, the first couple of years of the event, I literally was like in Hawaii with my wife on vacation. She's like, we'll take a vacation, you relax. I'm staring at the ceiling. My God, I'm going to lose $500,000 on this effing thing. Literally. She's like, what's wrong? It's like 2 a.m. Why are you awake? I'm like, I'm going to lose $400,000. Like,
exactly.
Scary stuff. Yeah. All right, listen, when we left our hero, Jason Lemkin, you can follow him, by the way, on Twitter, Jason LK.
Yes.
We were talking about what you look for.
Yeah.
What does Jason Lemkin look for in
investing?
An angel investment in the SaaS space?
Well, let's step back because I spent the last 2 years doing VC investments, and I think I invested, including reserves, $40 or $50 million notionally, right? And
$40 million?
It's not that much.
Oh.
I sourced or led 10 VC investments. Average check size was $2.5 million.
Got it. With Storm
plus
Ventures.
Reserves, and it adds up to. Including,
but you're not
notional.
at Storm Ventures anymore. You're on your own.
I finished my 24 months. I learned a lot.
Good.
I'd made some epic investments. And going, and I'll
Which
tell
one
you.
was the most epic?
They're all, it's hard to.
Which one has the most objective returns now on paper?
On paper?
Yeah.
I think the ones that have the highest NAV or markup are Talkdesk and GuideSpark.
Okay. So tell us about Talkdesk.
And those are both 10x already.
Wow. I have it on the screen right now.
But yeah, and I'll talk about. I can talk about a lot of things, but let me step back for a minute and tell you the Uber thing the high level thing that I learned, and then we can dig into some of the companies. So I wasn't much of an angel investment before, and I did a few companies that are doing really well, but I didn't have the structure or process you did. It was mostly people just that I knew that I put some nickels into, and that worked out. But then what I learned, the biggest difference in today's world between angel and VC is sort of twofold. One, if you're a hot angel, right? If it's you, if it's an Aaron Levy, if it's a David Sachs, for different reasons, you can get into deals. Okay, what's your average check size as an angel historically? 25K.
It used to be. Now it's a little higher.
A little higher. Okay, but whatever it is, if someone's raising a $500,000 angel round, or even 250, or whatever it is,
there's room.
If the founder wants you, there's room. As a VC, if you're trying to write even $1 million check, $2 million, there's never room. There's never room.
In the angel round.
There's never room ever.
Right.
Ever. And so, until about 2010, I would say, in B2B, although this changed a lot in B2C much earlier, right? But in SaaS, as a VC, you could be a picker. You could sit around your office in Sand Hill until about 2010 or 2011. And to get a 7-figure check, every founder had to go around and suck up to you. And so you could be a picker, right? What you saw early, which a lot of enterprise VCs, is it became the founders have the power.
Sure they do.
But I don't.
The great
for VC,
ones.
it took longer. It took
Yeah.
longer. It took longer. And I don't think in SaaS that was really true until maybe 2011 or 2010. And now you can pick so early, right? And so my best investments, the Talkdesks, the Rainforest, the Algolias, the others we can talk about, they all picked me as a VC. I didn't get to pick them.
And they picked you.
Me.
Why? Why do you think they picked you?
They picked me because their guess was, out of what they could figure out on the internet, that I might be able to help them scale revenue more than the other guys.
Because you were blogging and talking about
And
it
I'd done it as a
constantly.
founder.
Yes.
There's two reasons. Well, actually, there's two
Credibility.
reasons. The second one is interesting too. One, they probably thought I could help them more than other VCs, which I've learned is certainly true. Most VCs can't add any value.
Really?
Right? Oh, yeah. But second, there's a second trend, which you saw early, but came much later to SaaS and B2B, which is founders want a VC that's a founder. That's
sure.
what we all want as founders. We don't
Yeah.
want the financial guy, the guy that looks us like a piece of meat.
Yeah.
We want the guy that did
Harvard
it like
MBA,
us. Yeah, we
whatever.
don't. And maybe that's not even a good thing. If we had more time, we could chat about that. Founders aren't the best VCs. It's the financial managers that are the most successful. Founders get passionate, they get irrational,
Yeah.
they don't get their reserves right, they have other issues. But as founders, the last thing we want is to work for the man. We don't want to work for the man.
Right.
So these are the trends that have changed it. And so it took me a while to understand as someone that had been a founder for so many years, and then sort of an angel for a little while, and then thrown into VC. I didn't even know what had changed. But then founders started to come to me in the early days.
Interesting.
And I didn't know what that meant. And then after about 6 months, I realized I'm done meeting with any founder that hasn't picked me.
Very interesting.
Done.
So you said, I'm not going to chase deals. I want the people who understand I have some unique value in the
Yes.
world.
And I went from doing 10 or 20 meetings a week to one. And I said, I'm going to meet with one founder a week.
And
One.
just what? Go deep?
I'm going to
prepared?
I'm going to pre-screen it. I'm going to do my homework, and I'm going to look based on what. And I'll tell you what my investment criteria are next. I'm going to look for the ones that I think are amazing, and I'm going to do my homework ahead of time, and I'm going to meet with someone that's picked me. Maybe they shouldn't have, but
Right.
they picked me, and then I'm going to try to do the best and try and meet with 12 a quarter, 14 a quarter, and try and pick one a quarter from that 12 and make the best investment I can.
Okay,
And it's worked
so-
pretty well.
What are your investment criteria?
Yes. So here's the gift that I have and that
Sure.
you have, but a lot of VCs don't have.
Okay, let me hear it.
Is that we've
I like
done
that
it.
you're including
is
me.
that we've done it. So first I met with all these startups, right?
Yeah.
And I took warm intros, which I don't do anymore. And I met with folks that were just looking for money, which I don't do anymore. And then I realized I could boil all this stuff down to 2.5 investment criteria and do just fine. One, and this is the one that VCs that haven't been founders don't get. Founder has to be better than me.
Founder has to be better than me.
The way I figured it, if I could have basically a low 9-figure exit in 2011 in SaaS, if the founder is much better than me, then they have a shot at a unicorn.
Perfect.
At least a 1% chance.
Right.
But it's so hard to be a founder for 5 years, 7 years. And in SaaS, it's even harder because it's very cross-functional. I need a VP of sales, VP of marketing, VP of product, VP of customer success. I can't just sit in my office and be cool. And so it's so hard. So if you're not better than me, there's just no chance.
Right.
So anyone that I meet, I don't care what the numbers look like, the pre-traction, I don't care how cool the product is. If they're not better than me, I'm done. Right? And most VCs have no idea what that means, but you know someone that's better than you, don't you? How long does it take you to figure it out?
Very quickly. I mean,
Very
I have
quickly.
I think my preternatural ability is being able to know somebody's resilience, somebody's ability
Yeah.
in a first 5 minutes of meeting them.
Yeah.
I can really tell. I mean, it's from years of poker, years of meeting with people, and being a journalist. Like your radar just becomes. I mean, sometimes I'm wrong, but not often.
You know, I met Travis Kalanick, who wouldn't remember me from anything.
Yeah.
Right after his Red Swoosh, was that his last company got
Sure.
sold? I met him,
Exactly.
and at a
There's
random
big,
lunch.
There's a big neon sign above his head that says "winner."
Yeah.
It's-
And I met this guy at a lunch in,
Yeah.
this is a long time ago. This must have been early 2005. Does it sound
Yeah.
about right? Something like
Yeah.
that. And he explained the entire future of video on the internet to me at lunch. And I'm like, this is one of the smartest people I've ever met on the entire planet.
Yeah.
Right? And then now that I'm an investor, now if it was someone like that in SaaS with 10 customers, I'm in.
Yeah.
Okay.
Perfect.
So just as a touch point here, right? Just so much better.
Right.
Right. So number one has to be better than me. And there's so many founders and they're great and I love them and we're
Right.
together, but I can't invest if they're not better than me. It's too hard.
Right. That's an
So
interesting one.
second criteria, which ties to Talkdesk and some of the others we're talking about, what I learned is I got a product. I dragged a product up from nothing to 8 figures in recurring revenue at a blended price point that was about $15 per user per month. What I'm looking for are better unit economics than I had. Because if your deal size, not just your pricing, but the total deal size is higher than I had, then for the same amount of work, you're going to get there faster.
Right.
Right?
So simple.
So if your product's $7 a month, $5 a month, $3 a month, generally speaking, I'm out.
Right. It's just like
I'm out.
Apple. Like if Apple's, Android might outsell Apple, 5, 10 to 1.
Yes.
And they don't make any money
Yes.
per
It's hard.
unit. The unit economics are terrible.
Right. So if the founder's better than me, but the unit economics are even worse, his or her ability to get to 100 million in revenue, it's too hard.
They're sprinting
So I'm
through
out.
oatmeal.
I'm
Sprinting through oatmeal.
Through oatmeal. So when I look like at Talkdesk, we can chat some other case studies. Talkdesk, I invested, last summer at $1 million in revenue. Now it's in 8 figures. An amazing CEO, better than me, amazing team, amazing everything. But one of its secret sauces is when I invested, the product was, I don't know, on average probably $15 or $20 a month. Now it's $100. So it just is, and they've worked incredibly hard. They've done an amazing job. But if they'd done the same amount of work and still had a low-end, cheap product, it just wouldn't have, quantitatively, it wouldn't have gotten as far, right? So it's got to have better unit economics, be better founder. And then that's really it. But then there's a third criteria, which you have to worry about in angel investing, but it's even more important with institutional money if you don't have a $1 billion fund, which is I will invest in companies that are very boring today. Another call center software, another QA software, another search as a service company, another e-discovery company. These are 4 that I've done that I think will be unicorns. But if I say call center, search as a service, QA as a service, and e-discovery as a service, you're just going to yawn, right?
You're like, oh, that didn't work.
Or it's just
crowded.
boring. Oh, it's boring.
Yeah.
But what I need to know is the next guy won't think it's boring, right? That it will become a hot company.
Got it.
Because the next guy, like the further you go downstream, it has to become hot or no one's going to pay the crazy valuations we need.
All right, let's look at this one. Algolia.
Algolia, yeah.
How did you find Algolia? I have it here on the screen.
Yes,
And,
I love Algolia as well.
Build unique search experiences.
Yes.
Okay.
So here's an interesting one in terms of the changing world. So Algolia was out of summer of YC last year. It was doing $10,000 a month in revenue at the time. Wanted to raise it $12 million pre out of YC. Sounds expensive for $10,000 a month in revenue.
Ridiculous.
And had 7 million of folks that wanted to invest at a demo day, before demo day. It was one of the hot companies.
Yep.
We could talk about why. The team is an A+. It was really great. But the team had spent 2 years, broadly speaking, building a company all the way to about $10,000 a month in revenue. And they picked me.
Really?
They came out of YC. They didn't want VCs. They already had European VCs and some really great ones in the company actually before YC. And they're like, we got enough YCs. But they, hopefully for better, they picked me. And this is one of my learning experiences was I got picked. And you don't always, and when you get picked, you can't buy 20%. You have to buy what's available.
Right.
And if there's 7 million on offer and they want to raise 1.5, like you kind of have to roll with it. You take what you get. And I learned a lot of lessons from that. So fast forward, Algolia will shoot past 5 million in revenue this year. So in 18 months, they'll go from 10,000 a month to over 5 million and accelerating.
Wow.
So
how much is a company in SaaS worth if they're growing quickly, just ballpark, times their top line? What's the exact ballpark number?
Well, it's interesting because the last quarter or so, there's been huge multiple compression.
Right.
Huge multiple compression.
Okay, where was it at the peak? Where is it now?
I would say if it were this summer, then this past summer,
2015.
Summer of 2015, then a company like Algolia might be worth 30 times its revenue rate.
30 times. So it's a $5 million run rate, $150 million valuation.
Yeah, or maybe even more, because it's a hot company, great team, and great growth.
Okay.
150.
Now, but
right?
that didn't make much sense.
And some companies did, or even higher.
Right, because you had Zenefits, which was doing $30 million in revenue.
Yeah, we can talk about Zenefits too. Yeah.
Okay, we'll get to that. But it was. Oh, let's talk about it now. $30 million in revenue. I think it raised at $4.5 billion.
Yeah.
That's 150x if I'm doing my math correct.
Yeah. Yeah. And that's based on an aggressive but not wholly irrational model
that they would hit 100 million the next year.
Yeah, 100 million, and then keep going, right?
And then 3x that to 300 million.
Yeah, then keep going. Yeah.
So if the next year's
and the truth is they won't be far off, and they have an amazing team.
Right. So if they hit 100 million the next year, they would be the 4.5 would be 45x.
Yeah.
It would drop from 150 to 45, and then if they triple again,
it
goes from 45 down to 15x.
Yeah.
And you assume there's a bottom line in these SaaS businesses of what?
What is by bottom line? You mean what's the ultimate? What are the ultimate margins?
Yes.
At some point, you're looking for a 75 and 25 model, right? You're looking at 75 or higher gross margins, right, and 25% or higher net margins at some point.
What are there public companies with that profile? Is that like sustainable?
Well, sure. I mean, if you look at the classic software companies, the Microsofts and Adobe's Intuit, they all had that model, right? And then if you look at a lot of SaaS stuff, they all hit the gross margin number. The Salesforces, the Workdays, unless you have a lot of services built in, they're all 75 or 80% gross margin. But they're all doing the Amazon thing where they're reinvesting all the cash.
What do you think of that in this environment?
Yeah.
Of nobody ever showing a profit and just keep putting it to work? Do you think that's unhealthy, or do you think it's healthy and necessary? And why?
I think that if you're the CEO of one of these companies, you want to play the cards that are in the deck as best you can.
Mm-hmm.
So if you have a sales-driven model and it's a competitive space, you might want to spend up to 2 years of cash, of sales and marketing to acquire a customer. That's what Box was doing pre-IPO. It was spending 2 years to get a customer. On the theory, it will keep them for 3, 4, 5, 7, or 10, and then it will do upsells and upgrades.
So if the person is going to be a $300 a year customer, we can spend $600 a year acquiring them.
In sales and marketing.
Which is a little scary.
It's aggressive. And Box isn't that anymore. As Box went public, it scaled it back, and Box is doing 300-something million in revenue now. So it all worked out, right?
Right.
But Box is one of the best SaaS companies of all times, but it's also in the single most competitive space, and it has a low average deal size. Like the ticket size is low. And is there anything more competitive than in Box? There's nothing more competitive on the planet.
Which is like storage and file sharing.
Yeah, I mean, Box is really more enterprise. We could dig into the nuances, but the more competitive it is, the more you're going to spend on sales and marketing. It's not a little bit more. It's like you'll spend almost an infinite amount of money, right? And if you want to beat Box, and Box could spend 2 years of sales, how much do you have to spend for your startup, right? So there's a land grab issue and there's destroy the competition.
What do you advise your companies? If you're talking to Rainforest or Talkdesk or Algolia.
Yes, sir.
Algolia,
Algolia, yeah.
If you're talking to those 3 companies, what do you advise them in terms of how much of the lifetime value should you spend? If you know your lifetime value is going to be $1,000, $300 a year for 3 years.
Yeah.
What would you advise them to spend?
So here's my learning. What you have to understand, you have to step back and understand what your core unit economics are.
Unit economics.
Because ultimately what happens with every company on the planet is most of our customers come from our brand. Once you have a brand. In the beginning, we don't have a brand. And then usually around $2 million in revenue, we have something I call a mini brand, which is maybe people on this podcast and this video haven't heard of it, but in your little niche, in your little industry, like your little QA or
Buffer app.
Your little thing, people have heard of you, right? And
like
so
Buffer.
Probably around $2 million in revenue, everyone had heard of Buffer all of a sudden.
Sure.
Right? And before that, no one had heard.
Mattermark now hit like 2 million.
So you get a mini brand.
Mini brand.
And so what you want to understand at that point is, and what happens when you have a mini brand is you get leads that are free. People have heard of you. Not enough to get to $1 billion in revenue, but people start coming to you. I've heard of you. Can I have a demo? I've heard of you. I'd like to buy it, right? And so at that point, take a pause and say, what does it cost for me now? And I have a sales team now, and I have a marketing team. What does it cost for me to close that customer? My hope is that it takes 30 or 40% of your first year's revenue all in to close that customer. And if that's the case, then you know your core is healthy. And then you can take a pause and you can say, okay, how much capital can we raise to get what I call the incremental customer, the ones that otherwise wouldn't come in? Because the faster you grow, like a Zenefits, like the premium you get for that is not trivial, right? Zenefits got the greatest, valuation of all time, but it had the fastest growth of all time, so it deserved it. So to the extent you can, even if your core is working like every day, you kind of want to at least do an exercise. Can I be like Zenefits? Or can I come as close to I can? But it's hard if you haven't done it before to understand whether the core is healthy, but the incremental customer is expensive, or whether every customer is expensive, right? And it's especially hard for a VC to understand that. You have to really dig in and understand it.
Because there's so many different channels that customers are coming from.
And you get these blended numbers, or you haven't done it before, and it's hard to know, right? And so I try to quickly understand is, when you have a mini brand, will customer acquisition be dirt cheap? Then I get excited.
Let's talk about Slack for a second.
Yeah.
The software is not all that complicated to build.
Yes.
Do you think Google Apps, right? Because I use Google Apps. I'm already logged in.
Yeah.
Do you think Google or Microsoft, because they have Yammer, will launch a similar product, make it free as part of their bundled offering? And if they do, what impact would it have on Slack?
Let's talk about that topic, because especially in SaaS, competition is something we obsess about every day.
Yes.
It's true in every space, but it turns out in this sales-driven thing, when we have leads come in and we're competing with someone, it's especially dramatic and stressful.
Why?
Because it's so visceral. You and I are in the sales team at Zenefits. You and me, we're junior sales reps, right? And we're competing with, or pick any vendor. Like, we know, like, there's a bake-off and the prospect's taunting us, and I'm going to choose Zen Payroll or Gusto over you if you don't cut your price. But Zenefits is free, but you have to cut your price more. It's just, sales is, it's fun, right? It's hunting, but it's stressful, right?
So what happens to the...
So let's talk about when they build a Slack.
Yeah.
Right?
Would that materially impacted if there was a free version out there?
So it's an interesting thing I learned, and I didn't fully understand this until I was a VP at a Fortune 500 software technology company. I didn't get it as a founder and entrepreneur. Here's what I've learned. First of all, at every established tech company, there are great engineers. So do not be arrogant about your team. Do not. There are better engineers at Microsoft and Adobe and even Oracle and even SAP than at your so wonderful startup.
Even if you're like the unicorn of the moment,
don't be so
Zenefits
cocky.
or Slack,
Don't be so cocky. Your engineers are so great.
You could be out-Slacked, out-Zenefitted.
Now, for example, for me at Adobe, many of the great engineers had been there a long time. They might have been in their 40s or 50s rather than 18.
Right.
But man, they're good people.
Right.
Okay, they're good people.
They might be a little bit slower. They might not be willing to work 80 hours a week like maniacs.
But they may be more efficient.
And
so my learning is don't be so arrogant coming out of launch or coming out of whatever.
Yeah.
They can build anything they want and better than you can. Okay, and the folks at Adobe built amazing products. And in fact, a fun Zenefits example, Zenefits today announced they built their own payroll service.
Yes.
Right, but that wasn't the interesting. The interesting part, if you read the TechCrunch article today, is Parker took a team of engineers.
Locked them in the Marriott.
But you know how long it took?
6 days.
60 days.
60 or 6?
It's not 6. You can't build a whole 50-state
60
payroll.
days.
But 60 days.
Yeah.
So you think any technology company on the planet can't build their own Slack version or whatever in 60 days? Or 6 months or 9 months, it doesn't
matter.
Whatever it is. Right? So the more interesting question isn't, are they going to build all these clones and stuff? Of course they will. At big companies, the other thing, unlike startups, they always have extra engineers.
Yeah.
No matter what they say, there's always extra guys.
Sure.
There's always extras. And even if there aren't, they can just rip them off that boring old product and put them on something new. The interesting question is, how long can they sustain it? There's budget issues and other issues. So anyone can build something. But then this stressful thing happens. You actually have to monetize it.
The wherewithal.
You can launch a free product, but and then I need to monetize it. And then I need 50 engineers to monetize it. And then I need a sales team. And then I need a dedicated marketing team and a marketing budget. And that cheap product that took 3 or 8 or even 10 engineers to build all of a sudden becomes like 150 or 200 heads.
Right.
Right? And let's imagine I don't know all the other numbers. Let's imagine when I was at Adobe, there's 14,000 employees. Well, that doesn't seem like a lot. That's like your 5 engineers aren't a lot, but when I need 500 people to compete with Slack, all of a sudden, where do those 500 people come from? Because headcount is fixed in big companies. Headcount is fixed at Salesforce. Headcount is fixed at all these other companies.
Because they got to keep that 75-25.
That's how in a big company, the only way you can manage a budget is with numbers of headcount. You don't even do it by salaries. You just do it by numbers. And each division gets a certain amount of heads. And so eventually what happens is you can build anything. And you can probably build something that's better than Slack, given enough time.
Why not? You can standing on their shoulders.
But you run into these headwinds in year 2 or year 3. And so you need, what was Google's Evernote clone they built? Do you even remember? It was called Keep.
Yeah.
And I'm sure.
Yeah, Keep was, I think, it was a note-taking.
Yeah, and how many folks worked on Keep? 3, right? Or 5. But then how do you sustain the momentum?
Yeah.
Right?
It's funny, I was using Keep today. It's really nice.
It's nice, but how many people work on Evernote? Right?
A lot.
So is Google really going to put 300 people on Keep?
Well, Google Plus would be the best example. Like, they're like, oh, we're going to, or Bing and competing with Google.
Yeah, or Google, Google Voice is even better. I love Google Voice. I don't think a single person works on it anymore. I think those resources all got redeployed to Hangouts, right?
It's amazing.
So when Google Voice came out, if you're a startup, you could you're like, I'm dead. Google's giving away free telephony, voicemail, everything to the entire world. I'm dead.
Right.
But if you were Ring Central or whoever and you kept your head down, Google didn't maintain the commitment.
Got it.
Sometimes they do. If it's you have to really understand, is this really core? Or if it's not, if it's core, they're going to keep at it forever. But even Google Plus did not end up being core, did it?
Right.
It seemed core with Facebook, but at the end of the day,
I mean, they put it as part of the default navigation on every product. It seemed as core could be.
Yeah.
And then at some point, Larry was like, enough. Everybody's so annoyed by this thing. I don't want to. Too many people are coming to me.
And it turns out in sales-driven models, it's even harder because you don't just need all those engineers. You need like 100 salespeople, right? And they have.
So there's something to the wherewithal of big companies that, they can start something just like everybody did a Groupon clone.
Everyone did.
Facebook did a Groupon clone. AOL did. Wow.
But they couldn't sustain it.
And they're like, this business is horrible. I don't want to do this anymore.
Yeah.
Then they give up.
Yeah.
Interesting.
So I worried about this. In fact, if I'm honest, one of the reasons I sold to Adobe is because they were so aggressive about competing in the space. And I'm like the Adobe brand. I'm in digital
documents. Supposed to give you $100 million, to be honest.
Yeah, but some of it was a bear hug with a lot of threats. And if you don't sell, we're going to buy your competitor.
Really?
And when you hear that, and that's just part of M&A and corporate development, you can't take this stuff too seriously, even if it's true. And I'm sure it was true. But you're like, oh my God, I mean, these guys have an $800 million franchise, and they have every customer, and they have the brand, and I have a lot of customers, but people are going to trust their brand.
How does a big company communicate that to a little startup without pissing off the founder? Because for some founders, listen, by definition, a founder is going to be a rabble-rouser, rebel, fighter.
Yes. Yeah.
So if you tell a fighter, hey, listen, sell or we're going to kick your ass.
Yes.
That's like poking a tiger. I mean, that just instinctually might swing at you.
My own experience, but then when I've talked to other founders, it's usually the same shtick. And what it is you get approached, and they say, well, Jason, we're thinking about doing a build, buy, or partner decision. Build, buy, or partner. And that way, no one wants to make an offer and have it slapped away. There's a lot of not just ego issues in big companies, but there's structural issues. A VP or an SVP doesn't want to put a deal on the line and then not close the deal.
Right. So, egg on the face.
Yeah. So they're going to tell you build, buy, or partner, even if the only thing they're looking for is buy. Right.
So they'll
tease it out. We're looking at build, buy, or partner. What would you like to partner with us? But in all disclosure, we might build it ourselves, but we haven't started yet, or we might even buy something in the space. And they'll look and see if you lean forward or what the body language is, and they'll know, right?
It's a little bit of a poker game.
A little bit of a poker game. And everyone starts with a build, buy, or partner. That's just I think that's in Corporate Development 101 in the book that you can buy on Amazon somewhere. Build, buy. And so it always starts there. And then usually the threat comes along when there's interest in the buy, but not fall over out of the table interest, right? Or people, they get like, I don't really need to do this. And because deals
Wait, who doesn't need to do it?
The target, the startup, right? It all starts up nice.
Yeah.
And then sometimes you realize when you get into it that maybe, I don't know, I don't need to do this.
Yeah, we have money in the bank.
We have money in the bank. We're doing 10 million, 20 million. We're profitable. And so then then the kind of the threat side comes out in almost every deal.
How do they communicate the threat?
Well, they're honest, and they'll say, when they see you waffling, they'll say, listen, if you don't want to do this, it's okay. We understand.
Oh, so that's nice.
Yeah, you're nice.
It's
but
totally
just
cool.
to let you know, we'll buy the next guy on the list. And there's truth to that. That's not a threat. That's not a threat.
It's reality.
It's reality, right?
Yes.
And even if it's not reality, it's close enough to reality, and it may become reality. When a company decides they want to enter a space, right, they really enter it and they want to buy. They want to accelerate time, and they want to accelerate traction, right? Yeah. So they either do one of two things. Either they'll buy any vendor, but they want to buy the best one that matches their needs, or there's really only one that they want. And you have to understand, and sometimes there really is only one solution, but other times you'll turn around, and if they believe they can push a product through their channel, then they'll do number 2, number 3, or number 4, even if maybe they shouldn't, because they believe their wonderful sales team or their brand or whatever can push it through the channel. So you have to know. It's hard to know.
Yeah.
And if you look at a lot of M&A and you're like, well, why did Salesforce or Google or Facebook buy this company sometimes? Sometimes it was really the second choice, right? You didn't really see what happened for the first
Fascinating.
one. Right? And where it's more common, and what I learned is there's 2 types of M&A. There's CEO level M&A and SVP level M&A.
Oh, explain.
When I'm Mark Zuckerberg and I want to win, I'm going to give 10% of my company to own WhatsApp. Leave me alone. I don't want your opinion. I don't care what the board says.
Yeah, he did that.
10%.
He didn't even go to the board. He's like, I have super shares.
Didn't care. Or for Instagram. You know why? Because I know this is the winner, and I know if I give 10% of my shares to WhatsApp, my shares will be worth more than 10%. It's accretive. It's a no-brainer for a founder.
I get everything above the 10%.
The board thought this was insane. 20-something billion by the time the deal closed as a founder. So CEOs almost always know the exact target they want. It may be maybe Oculus was the wrong choice, but it was clear that's the one he wanted. Yeah. Right? Unproven, not launched, 22-year-old founder, but this is the one I want. SVP-driven deals are less about the 5 and 10-year future of the company, which is what CEO does, and it's more about making my plan. It's more about making my plan. I'm behind on webification. I'm behind on this initiative. And so an SVP needs to close a deal this year because I'm going to miss the plan.
He wants to hit the targets.
Hits the target.
Yeah.
Right? And they have
So
a
it's
budget. And they have a budget.
self-preservation in a way.
It's self-preservation. SVP, VP level deals, it looks like it's positive, but it's really generally to fill a hole, a gap that's missing, right?
Which isn't necessarily a bad thing.
It's not a bad thing. It drives a lot of 9 and 8 figure M&A is filling a hole, and you have a budget and you have a chip. But a VP level, when a VP level deal happens, they have their number one target in a space, and this is the one they want. And sometimes it's not rational, the reason they pick it. It may be because they're the ones that are in TechCrunch. It may be because the one that's prettier. But this is the vendor I want. But if they don't get number one, you know what they're going to do? They're going to go to number 2, and then they're going to go to number 3. They got to get a deal done.
Yeah.
Like I didn't launch whatever my note-taking application, or I didn't get my calendaring application done at Microsoft this year. We have a huge productivity initiative, right?
Yeah.
I got Javier at Acompli to run the whole damn thing. I'll pay him whatever he takes. I don't care if Acompli never got anywhere. I'll pay him the money.
Yeah.
But boy, we never even got to task management. We better go buy the best things. Let's talk to Wunderlist.
Sure.
And if they're not good, we'll go to we gotta make a play.
Yeah.
Right? I gotta make a play.
And it's all funny money. They have so much cash in the bank. It doesn't actually
It's
matter.
funnier than funny money.
Funnier than funny money.
It's funnier
What does
than
it
funny.
mean?
Because when a big company buys another company, it's just an asset on the balance sheet that changes from one bucket to another. I have a balance sheet. I'm a big tech company. I have billions and billions on my balance sheet. It's in cash or it's in other types of assets. If I buy a company, it actually doesn't cost me anything. Cost me nothing. Because I take some of that purchase price, that 50 million, 100 million, 200 million, and I put it into something called goodwill.
Yeah.
And it actually costs me nothing. If I have $4 billion on the balance sheet and I buy a Acompli for whatever, 200 million, whatever the deal was, I still have $4 billion on the balance sheet next day. Now I have less cash. I might have 200 million less cash, but I still have an asset. It's the same thing.
Because you say the asset is worth that. That's the goodwill.
The same thing that's fueling corporate venture capital as an aside. It's the same thing. Now, if I take that 200 million and I hire 1,000 engineers, you know what? That destroys my profitability. It hits my EPS, my earnings. So it's much cheaper to go buy something than to spend all the time and money to build up. Because not only is it not my money as a VP, but it doesn't even cost anything that moment in time. Now, the headcount costs money later because then it becomes that's why when you need 200 salespeople to compete with Box or 400, then it gets expensive.
It's real.
Right? But buying the company might actually cost nothing.
Yeah.
It's not even funny money. It's balance sheet management.
Let's talk a little bit about the mini correction we had over the summer and into the fall with the China meltdown. Then we had a massively strong comeback. But we had Fidelity here. We're talking in the fall of 2015. Maybe the winter now. I guess it's November. And a lot of the unicorns got written down by Fidelity, including Zenefits and others, Dropbox.
Yep.
And it seems like the peak was reached sometime in the middle of this year, 2015.
I think around June to July.
And now we're coming back down to reality. What is 2016 going to look like? Are you in the camp of sideways, up, down, reality, explosion? What?
Well, so, we've been doing this for a while. There's always this sine wave type up and down, and no one knows.
Nobody knows.
I'm not even sure we're in a correction. Some of this, look, NASDAQ hit a peak over the summer, and it's had ups and downs. So I guess venture and startups should be. But I think some of this is self-created by VCs and press and others, which we could chat about. I think VCs want to look for press. Look, I'm not no critic of a press. I mean, we both blog and do lots of stuff.
Yeah.
But you're looking for a story. Everyone's looking for the moment that in the tea leaves things stumble because they've been so good for the last 4 years. They've been so good.
Yeah, I mean, since the financial crisis, arguably, since, what is it, 2008? I mean, it's been a bull market for 7 years.
08 to 11 was good.
Yeah.
But 08 to 11 just got us back to where we were before. This 2011 to
enough.
2015, it's the best of times.
Yeah, it's a golden
Unless you count the idiocy of 98, 99, 2000. But this is the best of with real revenues and real profits. It's never been better.
Right. It doesn't feel bubbly because
it's just high multiples. It's high multiples.
Higher multiples, but not bubbly because if the valuations came down, the chances of the revenue going down, that's not going to happen.
Yeah.
the revenue is still there. It's not like people are going to stop using Airbnb tomorrow.
Yes.
They love the product. It's still going to grow. It's still massive global expansion for a product like Airbnb.
Massive.
So the valuation go from 25 billion back down to 10 or 15.
Yeah.
But the user growth is going to still be there.
It'll still be there. Eventually you catch back up to that multiple. It just may take a year or two.
Right. Which means who cares?
It doesn't really matter.
Keep your head down. For guys like us, we just keep our heads down and keep working.
Keep your head down. And the real lesson in SaaS and B2B is most folks really screwed up in 08 and 09.
Explain.
They really screwed up. What almost everybody did, including Salesforce, was they cut back. If you talk to any senior executive at Salesforce, I think if you ask Mark Benioff what his biggest mistake in the last 10 years at Salesforce was, he stopped hiring in 08 and 09. And yes, what happened was everyone got scared.
It was pretty
Customers tried, but in SaaS with these fundamental products you run your business on, they tried to renegotiate. They tried to cut the prices. They tried to buy the fewest number of seats possible. But you know what? Unless the companies went bankrupt, you know how much logo churn we had or customer churn we had? None.
Yeah.
And it all, so stay the course, right? And so if 08 and 09 from a revenue perspective was not important in SaaS, whatever happens in Q4 of this year, Q1, I just don't care.
Right.
All right. If 08 and 09 didn't hit us, right? And especially the guys like me at EchoSign and others, when we were building our companies in 08 and 09, we did have a bit of a growth hit, but we all still grew really nicely. Even through those years.
That's
we
the
all
thing
grew
is,
nicely.
I mean, even during the dot-com crisis and 9/11, tragically, one of the things that still happened was, despite all that, despair in the markets and in people's personal lives and as a country, the growth and the utilization of the internet, the growth of broadband, the growth of software eating the world, all that just continued.
Didn't stop for a minute.
Didn't stop for a second.
Yeah. But what we didn't know in 08 and 09, even Salesforce didn't know this, even Mark Benioff, we didn't know that we should keep selling through it.
No.
It was scary. It was scary for all of us.
Well, yeah,
right?
I mean, when the stock market gets cut in half, I remember I was at the Allen and Company secret conference in Arizona.
Yeah.
And I'm sitting there with some of the guys and gals from like Fidelities and stuff like that. And they're at the bar and we're drinking Macallan's 20, these are like double 18s and these guys are pounding them and gals are pounding them because they're so depressed. And they were talking about the NASDAQ at 2,500 and they were saying, I think we're going to hit NASDAQ 500.
Wow. Yeah, it was
NASDAQ
depressing.
1,000 because we had gone from 5,000 or whatever it was, 4,000, all the way down to whatever, 2,000. And they were just like 1,800. They're like, hey, this could go down to 1,000.
And it was even worse. Like Kosdaq was shut down. Like you couldn't even trade stock in Korea, right? I mean, things were worse. But so I don't really. So what does it mean for startups, right? I think what it does
startups
mean,
in 2016.
What it does mean, and there's all this Bill Gurley stuff and all this other stuff about people spending epic amounts of money, and it's true, right? And
So he's right. Bill Gurley's right.
First of all, he's right, and he's hyper smart and hyper successful.
Pretty funny dude. Yeah.
But what I think that he has a very broad perspective, and when you have millions of recurring revenue with 80% gross margin, that's a little different than when you have negative gross margin e-commerce. Okay, right. It's not the same thing. And so really what you just need to do now, and this is all, I'm sure you've been giving this advice to folks forever, you need just to make sure you have enough runway to get through this, right? And what you really want to do, what I would do in SaaS is, if revenues probably have compressed 50% since the summer in many cases, 50% multiple compression. My shorthand way of looking at this is if you wanted to raise a Series A and you were hot in the summer, in SaaS, you need about $1 million, $1.5 million in revenue to raise up. If you're hot, now you might need 2.5 or 3. You'll get the same amount of capital at the same valuation, and it might feel the same.
But you need performance.
But the reality is your multiple compressed by 50%. Now, if it only took you 4 or 5 months to get there, does it matter at a Zen level? It doesn't matter.
On a Zen level,
I just had to get to $3 million to raise my $8 million instead of getting to $1 million to raise my $8 million at the same pre-money.
Unless you're one of these founders who gets valuation obsessive.
Yeah.
It does happen.
It does happen. Yeah.
Well, how do you counsel founders who get a little bit valuation obsessive? And do you think it is a trend, isn't it? Because when we were coming up, you were happy to get the money and get the right investor.
Yeah.
Now I see founders.
Yes.
Some of them I've invested in.
Yes.
Who get a great investor who wants to invest at price A.
Yes.
And then a knucklehead investor comes and they're like, the knucklehead investor is willing to pay A 1.5.
Yes.
And I'm like, take the other investor who's the legendary investor. Why would you take knucklehead for 1.5?
I don't always agree with that advice anymore.
Okay.
I hear your point.
Tell me why I'm wrong or right.
Because I think in the early-ish stages, that's true. Absolutely. It's certainly true in the angel stage. It's true in the Series seed stage. It's probably true in the whatever these things are called these days, Series A stage. Up to a certain point, it's true.
Yes.
It's true because you'll get more help. It's true for signaling for the next round. It's true
Correct.
for a million reasons, right?
Right. Network.
But then here's what happens in SaaS at a certain point. Then I get to the point, you know what? I need 20 sales reps. I need 20 sales reps, and I need a marketing budget. And you know what? If B tier VC will give me 20 million at the same valuation, and A tier VC will only give me 10, it's not just a question of price or even dilution. It's more capital. It's twice the capital for the same dilution.
That's a lot of fuel. That's a lot of fuel.
And I think today you have to say no. You might have to say no to at the Series B or late A level. You might have to say no to the celebrity VC, even though they're better and you want them, right?
What would be the multiple? Let's say take whoever you think is the greatest VC on the planet, top 3 or 4 VCs, and then just a nobody VC who was just up and coming.
Yes.
What to you would be the multiple at a B round that you would say, hey, at point X or whatever, it's worth it to take.
Well, let's use some examples from our case study today. Algolia, this YC search and service company, they raised a few months ago $18 million from Excel in their Series A.
Well, that's a blue chip.
That's a good one. No, it's a good one. Yes.
I mean, except for before Facebook.
And they had 4 term sheets, and they were all A tier VCs. They were all A tier VCs.
Was it big variance in valuation?
But because Excel's bigger, just because they're bigger, they were able to write a larger check.
Got it.
Right. So, and I don't know what Algolia is burning now, like $100-something thousand a month, but 18 million is like infinite capital, isn't it?
Sure.
Imagine they're burning 150 and they'd raise 6 million. Like it's just a different place. So I realized in SaaS, if you're cash flow positive and you're self-service, you could take this best guy, best gal, best whatever thing forever. You could take it all the way to the moon. Yeah. But once it becomes sales driven, I need more money. Yeah. Right? I want more money. And so I'll take a 20% discount or something for the right partner. But beyond that, it's not about the dilution. It's about runway.
There are a large number of startups today.
Yeah.
It's unlike anything we've seen since the beginning of the internet and even the software era in the 80s and 90s. What is your take on the number, just the sheer volume of logos, names, not money being invested, because it seems like that's going to the biggest, most established companies, but just the number of startups seems impossible to even process or comprehend or manage.
It is.
What does this mean for the startup ecosystem when everybody has a startup? And a lot of these startups hit 10, 20K a month in recurring revenue, but there's only X number of serious investors.
I'll take it even a level further. When I started being an institution VC investor 24 months ago, it took me until then to figure it out. Now, actually, now in 2015, it's not just the startups at 10K a month in revenue. You know what? There's too many at $1 million a year. At 100K. When I started doing venture investment 24 months ago, I would meet with any startup. When I did the 50 meetings a week instead of one, I would meet with anyone that hit $1 million in revenue that was growing 10% or more per month, because that's pretty epic. Like, I didn't do that.
Yeah.
Like all of my generation, even Box and all that, we didn't quite grow at that rate at $1 million. So anyone that hit $1 million growing 10%, I would take that meeting in a heartbeat.
Yep.
I didn't know that there were hundreds of these.
Right.
SaaS is 2 orders of magnitude bigger than it was in 2008. And so that's great. And it's great for companies that are capital efficient or bootstrapped or can work truly with angels or other sources of capital. But there aren't that many more VCs. And there's a lot more micro VCs, but all those micro VCs just add up to one big VC. Like the number of players for A and beyond hasn't changed that much. It hasn't. And now they have bigger funds. So the fund size might be 50, 60% bigger.
But the number of partners are not that.
Kind of the same. It's not that many more partners or that many more funds. And so the real, 20%. Here's where I boiled it down to. About 18 months ago, I figured out that in SaaS, you kind of had to potentially go from 1 to 10 million in revenue in 5 quarters or less. 1 to 10 million in 5 quarters or less. And I didn't do it, and Box didn't do it, and Evernote didn't do it, and we didn't do it. I certainly didn't do it, right? But the bar's gone up. The bar's gone up, right? That's the derivative or corollary of all this, and it's kind of sad in a way, because that's why I have to invest in folks that are better than me, because if you're only as good as me, there's too many. There's also too many, right? So it's not just...
What's the end game, then? How does this all end?
It's just pure math. If you can get to $1 million in revenue growing 20% a month or more, which is not twice as much as 10%, it's epically greater.
Yeah.
Mathematically, clearly, you can get to 100 million. It's not definitive. It's not for
guaranteed.
certain, but it can happen.
Yeah.
So that means any of these companies that are doing $1 million growing 20% a month, like 3 of them we talked about today, the Talkdesk, Algolia, Rainforest, GuideSpark, many others, they all have a shot at IPOing.
Right.
They all have a shot at IPOing, right? So anyone that's looking at the IPO market today and being dour or looking at this, I'm looking a few years down the road at this, and my jaw just drops at the growth rate of these companies. And I'm looking, I don't know how many of these will IPO, where they'll go, but we have so many more IPO candidates, right? But
What's
the
your
bar is
take on
higher.
that?
The bar is higher. And it's the scary thing for founders because more of us are going to be stuck in the middle.
What happens to
right?
the stuck in the middle? That's what I'm getting at with the end game. We
Yeah.
know what happens to the people who have escape velocity and they're going to
Yeah.
hit 10, then 30, then 90,
Yeah.
whatever. They're going to
Yeah.
IPO, they're going to get bought by Microsoft or Salesforce, whoever.
Yeah.
What happens to the people who are growing at only 5% month over month and
Yeah.
the trajectory is to hit 10 or $20 million in revenue?
Yeah.
What's going to happen to those companies? Are going to be zombies or just nicely profitable enterprises who give dividends back to their VCs? What's going to happen?
Well, this is something that as a founder I obsessed about. I did not want to be stuck in the middle. I knew I wouldn't fail,
Right.
Except for some brief windows. I knew just through tenacity and
Yeah.
I would never, but I did not want to get stuck in the middle.
Right.
I guess my learning, and because of what we just chatted about, more companies are going to be in the middle, right? Far more startups, right?
Seems like it.
But here's my Zen learning.
And the middle today is what winning was just 10 years ago.
Yeah.
It's
yeah.
really
It
weird.
is. It is. It's true. And so what really will happen is maybe you can even, if you need capital, maybe you can even raise a seed round or a series seed, a formal series seed. And then what will
Series
happen
seed.
is, but then what will happen is you'll hit $1 million in revenue, 2 million, and you won't be able to get that A. You just won't be able to get it. And this happens all the time now. So what do? Here's what I've learned. Suck it up and get to 6 to 8 million. Because if you're not growing fast enough at 1 or 2, but if you get to 6 to 8 million in revenue and you have a great product, you'll probably be growing 80% or faster at 6 to 8, and then you're very fundable. So
Fundable and purchasable.
And purchasable. So what you may need to do, and this is hard, you may need to suck it up, skip
up.
a stage, and you may actually have to grow slower than you otherwise
Yeah.
would. But as the brand comes together and the product gets together, if you can get to that 6 to 8 million in revenue, then you're going to get funded, right?
I see this a lot. I see a lot of companies like, let's say, Y Combinator companies circa
Yeah.
5 years ago or 4 years ago, or Techstars companies, where you're like, oh, that company's still going?
Yeah.
And they're like, yeah, you haven't heard of us for 2 years because we've had our heads down. But
Yeah.
look, we're at 2, we're at 3, we're at 1.5, we're
You
getting
just might
there.
have to come back a little later in today's world because the best ones are growing faster. So you might have to come back at even 6 or 8.
Yeah.
But I don't know it's the end of the world.
It's not the end of the world.
It's not the end of the world.
It's like
I did
having
this.
a
I did this
solid
event
business.
a little while ago with the CEO of Qualtrics. I don't know if you know anything about the story. It's a super fun story. But his dad was anti-VC, anti-everything. Started the company in the basement of his dad's house, and it took the CEO. It took Ryan Smith like 4 years to get to like $1 million in revenue. And he didn't even raise any venture capital until they hit like 40 million or something, and it was a huge round. But
I was on the board of Dine, which had the similar thing. They just
yeah,
dealt
but it took him a
revenue.
long time. Now he's in 9 figures of revenue, and it took him longer than it otherwise would have taken. But eventually, the brand got there,
Yeah.
and he outlasted the competition and outdid it, and now it's now it's a unicorn.
Amazing. So listen, you're out of Storm Ventures. What's
Yes.
next? What are you going to do next? You be an angel investor? You start your own fund? What's the story?
Well,
What are you thinking about?
You
There's a lot of
know,
options out there for
you'll
guys.
have to see. But I've learned a
You're gonna
lot
draw-
about
you gonna
venture
draw-
investing,
Okay.
and what I learned is I'm just getting good at it.
Just getting good at ventures.
Just getting good at it.
So,
So you
Mark
gotta
Andreessen's-
keep- gotta
I heard
keep
Mark
investing.
Andreessen's pursuing you hard. What's the story there?
Gotta keep investing.
What's the
You just
story?
gotta learn. I think.
Wow, he didn't even respond. Look at that. What a good poker player.
I think.
I say Mark Andreessen, I didn't even see no response.
Yeah. I
Would you
think the
consider
learning-
working at an Andreessen Horowitz?
I think that here's my Zen learning. I think for guys like you and me,
Yeah.
it's really fun to work collaboratively. We're founders. We
For
love
sure.
we love having co-founders
be on
and
a
a
team.
team. Yeah,
Yeah.
it's super fun. I think working for someone else is hard. It's hard. So you have to find environments where however it's structured, you're not working for someone else, right? Especially if you've had a little bit of success under your belt.
Of course.
right?
And this is why Benchmark
Yeah.
with equal economics
Yes.
is such a desirable place.
Yes. Although equal economics does not always mean that one person isn't the boss.
That's true. I mean, sometimes,
Right.
sometimes
Economics
somebody-
isn't everything. You could have 3 co-founders, and
Yeah.
one is more important than the other.
True.
Like, it has more equity. It doesn't have to be 1-1-1. It can be
Got it.
3-1-1.
So are you capable
Right.
of working at another company? Do you have another firm, or do you have to start your own?
Oh yeah, no. It's all fun. It's just I think you asked the ZenLearning, right?
Yeah.
For founders, I think it's just founders are different, right? We're wired differently. But I think I've just gotten good at it. And I learned this be picked and then pick learning. Took me a while to figure out.
Yeah.
And now I get it, right? You got to just be picked. And the beauty about early stage
I feel that way, yeah.
is you don't actually, if you're late stage, everyone kind of has to pick you because there's only so many Airbnbs when it gets to
Yeah.
But if you're early stage, there's a lot of startups.
Right.
So you just need one Talkdesk or Zenefits or whoever wants Algolia or Rainforest to pick you. And you don't need to see all of them, do you?
No.
You just need one Uber to pick you and your portfolio is okay. You didn't have to get into Airbnb if you got into Uber. It's okay. Right,
Yeah.
But if you're late stage, you have to see everything.
But it helps if you're the second investor in Thumbtack as well.
Yeah, they're all good.
what I
No,
read
but you don't. But you
in
don't
the
have to be.
Wall
But
Street
you don't have to be. But, yeah. But you don't have to. But you don't have to be in all of them, do you?
No, I mean,
You don't
listen,
have to be in all of them, right?
The life
if
we
you're-
live is so charmed as investors. If you are an investor who is desirable,
Yeah.
which I knew inherently, and you knew inherently because we were entrepreneurs.
Yeah.
And if you spend 2 decades being an entrepreneur like I did, or you maybe spent more, you just know that if you provide massive value on a consistent basis,
Yeah.
that separates you from 90% of the other investors who are at St. Bart's or in Italy for 4 effing months a year, calling in Rich to your board meetings while you're like trying to figure out how to hit your Q4 number in Christmas, and people are taking Christmas off, and then people are not taking their salaries, and then your VC is in Italy for 2 months.
There's the douchey thing. Like I remember an investor years ago where he came to my board meeting and he complained that the stitching on his latest Ferrari was the wrong color and wanted to send it back to Modena. Okay, so having said that VC is pretty good, right? So I don't. It's more that adding value in the amount of time you spend.
Wait a second, this is one of your VCs.
This was someone that almost invested in my first startup.
Oh, okay. Because I was about to say, producer Jackie didn't narrow the list.
Not one of my investors, almost. But I actually wish I'd taken his money in my first startup. He was very good. Because if you're very good at venture over time, you should make a lot of money, right?
The way I look at this,
if you're very good at venture, you should make a lot of, not as much. You shouldn't make as much as Travis Kalanick, but you should make a lot of fucking money if you're good at venture, right?
It is if you are at the top of the food chain.
Yeah.
What I tell people is my job is to not say no.
Yeah.
Right? Like I, as an angel investor, just have to be smart enough to not talk myself out of not investing in somebody who's an all-star. And that's what I did with Pincus and Ev Williams with Twitter and Zynga. I wasn't really an angel investor back then, but I looked at both those companies and I was advising them, should they take Fred Wilson's money or Sequoia's money or this one's money? And I was just rapping out with my friends over Pad Thai. And I just was like, I don't think that poker for virtual chips is going to work. Therefore, I'm not investing. And that's a $50 million mistake. And then I'm like, well, Twitter is a blog post without the blog post. So that's stupid too. I'm not investing. That's the idiot I am. And then once I missed those two, when I was right there and could have put any amount of money in my...
Then you nailed your thesis, right? Then you knew.
My thesis became very clearly, if this person is the winner, don't just bet on them.
Yeah.
Bet 3, 4, 5 times on them.
Yeah.
So I invested in Josh Williams for Goala.
Yeah.
I invested him last guide, and I'm talking to him today about what he's doing next.
And you're okay if you don't even really understand what they're doing?
Who cares?
Well, that's extreme. That's a true. I'm not. That's why I don't do true angel, right? I only do the stage you're doing if I know them personally.
Yes.
But and that fits your thesis, right? But if I don't know them personally and I don't really know what they're doing, I get confused.
Here's the thing. You have an expertise, which is SaaS. I don't have that expertise, but I have an expertise, which is people.
Yes.
And if I can look somebody in the eye and I could say, this person's a winner, they have resiliency, they're resourceful, and they have resiliency, and they have passion for this, and maybe they have sharp elbows, maybe they're a little hard to deal with, maybe some people don't like them, well, more the better.
Yeah.
A resourceful, person who is resilient, and some people don't like them, I'm going to bet on her all day long.
Yeah. And
That's perfect for me.
They get better over time. Those issues work themselves out one way or the other.
Of course they do.
They work themselves out.
Listen,
right?
I mean, is Larry Ellison and Benioff were so easy to deal with early on. Those guys were supposedly nightmares, and now Benioff is the biggest mensch on the planet. Guys,
everyone loves him.
I love the guy. I go to take my pregnant wife to the doctors. It's the Benioff building.
Yeah.
It's the Ron Conway building. They won't give him a big hug. You got to see this place. It's the greatest hospital on the planet. Benioff and Ron Conway they're canonized. I mean, these guys are going to be saints. The amount of money they're giving away.
Yeah.
It's unbelievable. Have you been to the San Francisco what is the university? University of San Francisco Medical Center,
Yeah.
USFD.
I had an office in Dogpatch for a while, so it's pretty
Oh, my
close.
God.
Yeah, it's pretty epic.
You walk around the hallways.
Yeah.
It's like being in the 4 freaking seasons.
Yeah.
I'm literally the hospital
Yeah.
that's providing free services to children and women is like better than my house. It's better than the Four Seasons. It's like unnecessarily generous. So thank you to Benioff and Ron Conway.
Yeah.
I mean, can you imagine these guys are not even old and they're just giving all their money away to something so beautiful?
It's amazing.
It was very touching to me. I was just like, wow, this is like, everybody, these insane people in San Francisco. I don't know
Yeah.
who these anarchists or idiots are who hate the tech industry. It's like, open your goddamn eyes.
Yeah.
And look at the major amount of tax and the $20 an hour, $30 an hour jobs for menial work. Menial work in this town is getting paid $20 to $30 an hour. There are people right now in Kentucky and New Orleans ripping their hair out at these anarchist idiots throwing rocks at buses.
It's true.
That they don't appreciate the fact that you can have no education and get a $20 an hour job on demand.
Yeah, it is interesting. Well, can I ask you one quick question?
Yeah, sure.
Let's go back because I think it's interesting for folks to your Ev Williams and Mark Pincus example.
Now you're interviewing me. Here we go.
But it's interesting because we're talking about money, right? So for a funnel perspective, those are pretty successful guys, right? How many in a quarter, in a month, in a year, whatever metric? How many folks do you meet like that meet whatever that bar is? Is it better than you, like me, or how do you think about it? And from a funnel perspective, how many do you think you meet?
Well, right now I have built an entire platform, right, with the events, with the show and everything. So I meet 104 people just doing This Week in Startups a year, right? So now you and I, we're not friends, we don't know each other, but after 75 minutes of this, 80 minutes of this, you and I are like,
we're bonded.
We're buds now,
we're
right?
Bonded.
Like, wow, that was an interesting conversation. So like, you're going to see some great company, I'm going to see some great company. I'm like, hey, I know the perfect guy for this. So if you think about the efficiency of that, 600 episodes in X number of years.
Yes.
And then the festival's 15,000 people. So
it's a big funnel. That's why I asked the question. How many come to the bottom of the funnel that you think are at that Travis, Pincus? And some of them can fail. It's okay. I'm not concluding the successes.
I wouldn't invest in them if I didn't think that they were just absolute winners.
Yeah.
But I will say that like coming across the Travis, Ev Williams, or Pincus is a rare breed, but I did see it in many people.
Yeah.
I saw it in Marco from Thumbtack, immediately, and I see it in people all the time.
Do you think you meet 10 or 20 of those a month? Or is that, how many unicorns are there out there, right? And I mean, these are pre-unicorns. They're not unicorns yet, right?
Yeah. I think my pace is going to be 40, 50, 60 investments per year.
Yeah.
As an individual.
And you think all those 50...
No other partners.
No other partners.
Just my
And all those
company.
50 you think rise to that level? I mean, not that they're going to achieve it, but they rise to that level, you think?
No, I don't think that. I think they have the potential.
Yeah, the potential.
But I think I am going to open a little bit, widen the criteria so that I can get people earlier and be their first check. Because what I've realized in my career is at the age of 44 is that I enjoy the act of creation. I enjoy the launching of the company. That's why I named my company Launch.
Yep.
And I love working with people as they get towards that goal. So when I see they have maybe 3, 4, 5, maybe 5, 6 of the 10 qualities I like, which I wrote about the other day, I'm like, that's enough.
Yeah.
I can start engaging with them. And if I put them in my incubator and I spend the incubator is 50 hours with each company.
Yeah.
If I spend 50 hours with them, I'm going to know if they're going to fill in those 3, 4, 5.
Well, that's for sure.
We had 15 people start my incubator in 2 classes and 13 graduated. So 2 didn't make it.
Yeah.
So that tells you something.
Yeah.
And then this time around, we're accepting 1%. So we have a lower acceptance rate than Y Combinator.
Yeah.
So this is cream of the crop. And that's the most fun for me. So I'm just going to optimize right now to do 7 classes of 7 a year, about 50 a year.
Okay, 50.
Is I think what would be perfect for me. And then I just need to get a bunch of the other syndicates and super angels out there to just, be more involved because I can't fund all of them. That's the problem.
You can't do all of them.
That will be the challenge now is I can put the first 250 or 150 or whatever into the company, but I'm going to need more people. I can't, angel investing has never been a solo act.
Yeah, you need more wood behind the arrow.
So what I'm doing now is, I think it'd be interested in your opinion on this is I'm front running the market. So Y Combinator is like, oh yeah, nobody gets to invest in these companies beforehand. We both know that's both bullshit. We know the people, Ron Conway, Arrington, whoever get early access because they're friends with Paul Graham. And Paul Graham tells them which ones to invest in, and it's all bullshit, right? Yeah, you think you're on that list too. You're laughing.
I'm not on the list.
You're not on the list.
But there is a lot of truth. Yeah, I think more YC companies have investment before they go in because they're later. They have more traction. But your point's well taken.
But there's always been a little game going on.
There's a lot of game.
There's an actual
program. There's always 3 or 4 or 5 companies that are clearly the breakout leaders.
There are 3 or 4 VC firms that they don't talk about it publicly, but it's legitimate, and I have it confirmed that go into their incubator early and meet with the companies. They meet with them.
I don't think it's even a secret.
It's not publicized anymore.
Yeah, it's like Scouts. It's not a real secret, but it's been written about many times for many years.
So because of that, I told Sam Altman, listen, I meet with 10 companies every class. I haven't invested in 1 in 4 classes.
Yeah.
But 2 of my investments have gone into Y Combinator, so I think it's probably a better flow for me.
Yeah.
But here's the thing, like, why would I be in competition with dentists for deals? Like, I come, that's what I told the guys over there, either I come early, and I'm part of the early secret group, or I'm out, and I'll just do my own thing, and that's fine. But I think that's what I'm doing with my incubator is I'm inviting 2 or 3 of my investor friends each week, and I'm taking it a step further. I'm having each of my founders open a note up at half of what their valuation will be at graduation.
Okay.
And the people who come, when you come be a mentor, which you're going to do.
Yes, I'm happy to do it if it's in SaaS, yes.
It's going to be half SaaS and half other, but some robotic stuff. It's crazy. You'll come and you spend...
I see. This is a way to compensate mentors in a really clean way. A really clean way, right?
You come, you bond, you get half price.
Yeah.
Then when it graduates...
Yeah.
Then it goes up to $6 million, $7 million valuation. Yeah. But in the incubator, it's a $3, $4, $5 million valuation.
Yeah.
For you...
But it's 50%, right?
Jason.
Yeah.
For you...
Yeah.
Half price.
It's actually it's very smart because the problem with these mentors is you can never pay them enough.
Exactly.
It's impossible to pay someone that has made a good amount of money. But 50% off, you'll always do it, right?
For you, 50% off.
Yeah.
Brighton Beach style, all right? We're doing like Brooklyn style.
So let me just finish up the question, just because I think it's so interesting to folks that are listening, right? Because you talked about how there's so many better startups today. So you're focusing on 50 a year.
50.
That you can find, right?
Easily.
So how many, I know it seems like a crazy question, but it is existentially interesting. How many great founders are there a year? Like great ones. Not that will build a unicorn, but that could. How many of these are there? How rare a breed are these? Because if you believe you find 50, there must be 500. There have to be 500.
Here's the thing.
But there can't be 5,000 unicorns, can there?
10 a year.
10
a year. After 10 years, you have 100 maybe. After every cycle of 10 years, maybe 20 a year.
But you think the 50 can be but you think 50 can be unicorns?
I think that they could be, but there's all kinds of things that kill those turtles as they leave the nest and they break out of the egg, and then the seagulls eat them, and then the sharks eat them.
But I think what a lot of folks do.
So I got to cast a little bit of a wider net.
But VCs make a mistake where they lower the bar because they don't have enough deal flow.
Yeah.
And then angels make a mistake as they get too excited about the subject matter or the listing or the pre-traction, right? And it's really hard for most angels to see the Ev Williams early. They don't meet him or her, and they don't get to know them, and so they have no idea whether this person is really Ev or not quite Ev. And the difference between Ev and not quite Ev isn't a little bit as an angel investor. It's 7 orders of magnitude, right?
Well, in the case of any company that becomes a unicorn, it could be 5,000x in terms of return magnitude. So if you just look at forget about the person and like that, just in terms of the investment quality, it's either 0 or 5,000x, or 10,000x if it's Google or Facebook, right? So I think...
Because the question I think for founders is how many of me are there? How many great guys can there be this year? Are there 500 of us?
No.
Not that we'll all build a unicorn. It's mathematically impossible.
No, there's 50.
Right.
And I'm going to get all
You think there's 50? Okay, that's a good. So you want to be in the top 50 worldwide.
I think in the United States.
Yeah.
What do we have now? They say there's 200 unicorns or something like that out there, 250 something.
Whatever it is.
And it took us 7, 8 years to build them up. So if you do that, that's 30 a year average. So if we just take the average from the previous years, maybe things are going up, maybe they're going down.
Yeah.
So 30 a year, if I put 50 people in, I'm going to catch 1 a year. I think I can catch.
So maybe is it 10x? Are there 300 ones that could become that 30? 300 great founders?
Sure.
Just like amazing Travis's that it didn't work out because it was a little bit of a different company, or?
It's just hard when you get to that elite scale of Elon Musk or Travis.
Yeah, but they're really good.
When you get to that elite scale, I think that, I don't know that anybody can identify them early. Like I knew people who were, maybe more polished than those individuals, maybe put on a better show, maybe had a better demo. But here's the thing. when you can look somebody in the eye and you feel the resolve, when you feel the resiliency, when you feel that they're going to fight, and their passion is there, and their ability to acquire knowledge is there, and their ability to build a team is there, like all of that starts clicking in. I'm like, okay, at least I know that if this person fails, they're going to do another company, and having been the backer of the failed company, if I'm the Red Swoosh guy, or I'm the Scour guy who backed Travis on Scour and Red Swoosh, well, I'm in pole position to do Uber.
That's for sure.
And Cuban was in pole position to do Uber, and it's his greatest regret that he didn't, but he backed Red Swoosh and I think multiple times and then didn't do Uber. So he made a mistake there and he knows it. But that's the pattern I'm taking, which is, hey, listen, I have a 10-year plan to be the #1 angel investor in the world.
Yep. And you need a 10-year plan.
I'm 5 years into it.
Yeah.
And I would say maybe I'm number 6 or 7 right now. I don't know what people would put me, but that's up to other people to put me, to rank me. But I put myself at 6 or 7. Right? I think there's five people who are better than me. Maybe 5, 6, 7. Maybe I'm 8. I don't know. Who knows? Anyway, we could talk for hours. We've talked for hours.
Oh, good stuff.
Quite literally.
This is great.
Listen, Jason Lemkin, super smart guy. I respect him a lot, and it's a pleasure to have him on the program. If you would like to learn a lot about SaaS, go ahead and follow SaaSTR on Twitter and go to Saastr.com. He's running an amazing, amazing event. It's his annual conference, Saastr.com. And the Saastr annual conference is on February 9th, 10th, and 11th here in San Francisco.
Here in San Francisco.
At Moscone, you said, or?
Masonic.
Masonic. Whatever that is. That's that skull and crossbones.
You'll see a little bit.
What is that? That's that whole, what do they call it? What's in Jay-Z? Illuminati?
Clearly you're not a Freemason. That much is clear.
With this fakaka religion stuff in the world is, I don't know, is Masonic religion or is it?
I don't know. George Washington was a Freemason, so there's got to be something.
I don't even want to know about this religion stuff.
Yeah,
I mean, atheism, please, for the love of God. It's whole.
They have a lot of big concerts there.
I'm going to go. So if you go there, you can sit next to me in the audience. It's going to be an amazing event, and it's very affordable. In fact, Jason's probably going to lose a little money on it. And thank you, executive producer, and my right hand, Jackie. Emmy award-winning producer Jackie. And we'll see you all next time on This Week in Startups. Bye-bye.